Good morning and welcome to today's webcast, Complex Gifts, Tax and Legal Issues for Tax-Exempt Organizations. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters, Tracy Paglia, partner at Moss Adams, and Matt Clausen, principal at Adler and Colvin. With that, I'll turn it over to Tracy to get us started.
Wonderful. Thanks so much, Kendall. And thank you, everyone, for joining us. This is a session that Matt and I presented in DC a few months ago and thought it went so well that we would like to do it for our audience as a webcast. So we appreciate you joining us today. Our agenda for this session is we're going to be covering some of the issues to consider when you're receiving complex gifts, maintaining complex gifts, or disposing of complex gifts. And when we're talking about complex gifts, we're really talking about anything other than stock, publicly traded stock, or cash. So it can be a relatively simple item or a very complex one. We'll try and cover a variety of those issues. And we will get started with a polling question. Kendall?
Our first polling question. What issue are you most interested in? A, issues to consider before receiving a complex gift. B, issues to consider once the gift is received. C, issues to consider when disposing of a complex gift. Or D, all of the above. I'll give you a few moments to respond. To participate, please click the button next to the answer you choose and hit submit. Matt, I'll pass it back to you.
Thanks, Kendall, and thanks everyone for joining us. So it looks like, at least so far, it looks like most people are interested in all of the above, which is good because that's exactly what our talk is designed to cover. So let's get going. So as Tracy mentioned, complex gifts, what we mean is sort of anything that isn't either cash going to a charity or publicly traded stock, because that's an easy asset for a charity to dispose of. It just has its broker sell into the market and it liquidates the asset right away. or holds for investment returns. But anything else that isn't quite so simple, which may be interests in closely held businesses, real estate interests, investment fund units, cryptocurrency, all of those assets tend to raise more questions, some of which are tax issues. Thanks for putting the slide up. And some of which are non-tax issues, which we'll cover as we move forward. So the donor and the charity have separate sort of sets of issues they care about in any gift like this, and we'll talk about each of them briefly here. The donor's concerns, the donor's primary concern in making a charitable gift usually is to do good, whatever that means to them. They're making this gift usually because they want to benefit the charity and the charitable programs. Often we're talking about appreciated assets, and so another concern of the donor, a tax concern of the donor, is avoiding having to recognize gain when that asset is eventually sold. And of course, the donor is often concerned with making sure that they qualify for a charitable contribution deduction. The charity, on the other hand, has a separate set of concerns, but they overlap somewhat because the charity's often the first concern is donor relations. Charities rely on their donors for support for their mission and their existence, and so they are motivated to keep their donors happy. When they're offered a gift, they want to be able to say thank you very much. They don't want to have to say, gosh, that's really nice, but could you give us something else instead? So they tend to want to take the gift if they can. And part of making sure that donors are happy and stay happy is to help make sure that they really are going to get the tax benefits that they expect. And we'll talk about that a bit. Sometimes there's a role for the charity to make sure the donor and the donor's advisors are correct in assessing what the charitable deduction will be and whether or not the donor will have to recognize gain. The charity is also concerned about liquidity. They don't want to be holding an asset that they can't liquidate or that doesn't generate any income. Unless they have a huge endowment and they can sort of spare some of their assets that way. Most charities need ongoing funding for their programs, and they want to be able to turn that asset into some sort of cash, either ongoing or just by selling immediately. And then the charity doesn't want to expose itself to liability by accepting a gift. And charities have their own tax issues, unrelated business income issues, and other tax issues that Tracy will cover a little bit later on. Okay, so in preserving the donor relationship, this is the first issue for most charities. As I said, they're motivated to keep their donors happy. The bigger the gift, the more important that donor tends to be for the charity. And so that, as we get into very large, complex gifts, there is sort of a strong motivation to work with the donor and make sure that the gift works as planned. And then if there are assets that the charity is just not comfortable taking or doesn't believe is sort of within their scope to handle, all charities should have some sort of gift acceptance policy and procedure, partly to help the charity know when and how to go about accepting these gifts, but also because as a matter of donor relations, it's nice to be able to point to a written policy and say, look, this isn't personal, we just don't take that type of asset as a matter of policy. Often a donor wants to retain some benefit or have some benefit back to them from a gift, and this can be done properly. Sometimes that's an income stream for life or to some relative. Sometimes it's remaining in the house while donating the remainder interest in the house, but keeping a life estate so that they can live in it. There are some tax structures that enable a donor to give and receive the tax benefits of a charitable gift now, but receive an income stream or hold on to a piece of property, some use of the property. I'm not going to go into detail on charitable remainder trusts and pooled income funds and charitable gift annuities. That's a 3-hour class when I teach planned giving, just to talk about those structures. But it's good to know that they are out there, and some donors will want the charity to assist them in setting up a structure that helps them retain some benefit, some economic benefit. Of course, that always reduces the amount of the charitable deduction because the donor is not giving all of the value of the asset. And then part of maintaining good donor relationships is understanding the donor's wishes, and we'll discuss later some issues around donor restrictions on how the property will be used. The donors can impose legal restrictions or just sort of express a wish, and then there's a sort of a question for the charity about how they go about implementing that. And then, as I mentioned, charities also need to make sure that they've sort of educated and or managed the expectations of the donor about their own tax benefits. This comes up particularly in the situation called the prearranged sale issue. This is where the donor has already taken some steps to market or sell an asset before making the charitable gift. If they've gone too far down the road towards sort of negotiating and committing to a buyer to sell the asset, and then at the last minute they give it to the charity, and the charity ends up being the entity that sells it, the IRS will treat that as, may argue to treat that as though the donor had actually sold the asset, recognized the gain, and then donated the sale proceeds. So that ends up, the donor still gets a charitable deduction, but they are also recognizing all the gain in the asset, which is probably what they were trying to avoid by structuring it that way. So that can be a big difference for the donor, and often the charity is in a position to help the donor recognize that issue and encourage them to make the gift sooner to avoid it. And the donor usually expects a charitable contribution deduction, and that depends a little on, quite a lot on following the Byzantine substantiation requirements for charitable gifts in order to take the deduction. And some of this depends on the charity. The donor will need a gift receipt from the charity that has to be received timely, and it needs to have sort of certain magic words on the receipt. Gifts over $500 also require filing a Form 8283, which the charity needs to sign. And gifts over $5,000 require a qualified appraisal. The appraisal is really the donor's issue, but the charity is often in a position to sort of help make sure that the appraisal meets all of the requirements for a qualified appraisal. And so those are all... Yeah.
Matt, before you move on, I often find with my nonprofits, they're worried about crossing the line of providing tax advice or legal advice. So they get an 8283 with an appraisal that doesn't look right, or they've determined that it's a prearranged sale. What are your thoughts on letting the donor know? How far should they go to let the donor know that there might be a problem?
Yeah, that's a good question. I more often than not, I represent the charity rather than the donor, and more often than not, we're the ones that spot the issue rather than the donor or their advisors. And I think that we can't sort of take an attorney-client relationship up with the donor and really like provide them with real legal advice, but we can flag issues for them. Send them copies of rulings or regulations, and just say, look, I think you should take a look at this and make sure that you're really going to get the benefits you're expecting here. And that's usually enough to sort of to move the conversation in the right direction. So as I was saying, the receipt and the appraisal all need to have very specific language in them, and it's highly technical and also very, very costly for a misstep. There are actually cases where multi-million-dollar deductions are lost because or are denied because the receipt doesn't contain the words "no goods or services were provided in return for this donation." So it's important to get these things right. A donor is going to be extremely unhappy if their deduction is denied because of some misstep of the charity that they just gave some huge asset to. All right, the next thing charities worry about is liability. They don't want to take an asset that actually is includes some risk or cost that outweighs the value of the asset itself. This always requires a fair bit of due diligence with complex assets, especially certain types of assets. Of course, you're looking for risks. If it's real estate, you're looking for environmental type risks. If it's a fund interest, you're looking for various other types of liability that I'll mention as we get to those specific asset types. But basically, the charity needs to make sure that it knows what it's getting into, what it's actually going to own at the end of the day, and whether there's risks associated with that. If an asset does come with some risk, and many complex gifts do, there are strategies to mitigate that. One fairly common one by now is that charities may hold sole member interests in single member LLCs. So they may have one or more limited liability companies that they own and control, and these are treated as disregarded entities for tax purposes. So as far as the IRS is concerned, it doesn't really matter whether somebody gives a gift directly to the charity or to the LLC. But for state law liability purposes, the LLC can sort of put a liability wrapper around that asset and whatever liability is associated with it. Another structure we've used is a short-term charitable remainder trust. Charitable remainder trusts, I said I wasn't going to talk about these, but very briefly, they are, it's where the donor gives into a trust, and the trust has as an income beneficiary, maybe the donor or some relative, and then the remainder beneficiary is the charity, and the donor takes a charitable deduction for the present value of what the charity is expected to receive at the end of the term of the trust. These are usually set up long term for the life of the donor, for example, but you can also set up a very short term, maybe 2 or 3 years trust, just long enough to be confident that the asset will sell. So the donor transfers the asset to the trust. The trustee, which may actually be the donor acting as trustee, then sells the asset, and at the end of the 2-year term, the charity receives all of what's left in the trust, which is almost everything. So the donor ends up with a charitable deduction of almost full value of the asset, but the charity never had to take title to the asset. So that can be another way to deal with problematic real estate, especially. And then there are independent entities that can help in this situation too. There are 501c3 organizations out there that for lack of a better term, provide the service of receiving assets that other charities might not be comfortable receiving, dealing with the liabilities, selling the asset, and then granting whatever's left over back to the donor's sort of chosen charity. These are often set up as donor-advised funds, where the donor has advisory privileges over where the funds get granted. They can't have actual legal control, or it's not a charitable gift in the first place. But as long as the donor is comfortable with the idea that, okay, I won't have legal control, but I will have advisory privileges, and I'm pretty confident that this charity, pretty much always goes along with its donors' recommendations, as long as there's no legal impediment to it, then that can be another way. There's always fees involved, but otherwise that can be another way to sort of deal with not having to take title to the asset that's got problematic liability. Looks like it's another polling question, Kendall.
Great. For our second polling question, Separate legal entities may be considered prior to receipt of a complex gift for the following reasons. A, the potential gift is an operating expense. B, limiting liability. C, use of the asset may benefit from a separate governing body. Or D, all of the above. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. Back to you, Matt.
Thanks, Kendall. Once again, it looks like people have chosen D, and I think that that's right. I mean, they can be considered for all of those purposes, and so correct, everyone. Good job. Moving on to liquidity issues. So I mentioned this briefly. Charities don't like to be stuck with assets that they can't either sell or monetize in some other way. They need cash to fund their operations, usually. So with any gift that isn't cash or publicly traded stock, we need to know what the market is. How easy is this to sell? Not just what its fair market value is, but how easy is it going to be for us to actually get that value? Restricted stock may have restrictions on when it can be sold or how it can be sold, to whom it can be sold, and other types of assets are even more problematic. Undeveloped land is especially a problem because it doesn't generate any revenue. It usually involves there's property tax and other holding costs, and it may be very difficult to sell, especially if there's any concern about environmental contamination. Other bad assets for liability include timeshares. People, for some reason, always want to give their timeshares to charity. Animals, collectibles, and pretty much any type of vehicle. Sailboats are sort of a classic example. People always think their sailboats are worth much more than they really are worth. And when they discover that it's expensive to own and hard to sell, they want to give it to charity instead. And there's no reason to think that the charity is going to have any better luck selling that sailboat than the donor did. So that's something for charities to watch out for. All right, so let's start talking about more specific asset types. One thing we see a lot is business interests, and one of the common ways that businesses are organized is through a C corporation, so we'll start there. As we've said, publicly traded, unrestricted stock is not really a complex asset, but there are restricted, stock that's not publicly traded has both securities law restrictions on who you can sell to, but also tends to have corporate governance documents restrictions. So there's often a shareholders agreement, rights of first refusal, and other reasons other documents that will affect whether the charity can actually, whether and when the charity might actually be able to sell that stock. Closely held businesses might be startups, companies that are expecting to go public at some point, but they might also be, the family business that doesn't really intend to go public ever, and that can affect the charity's exit strategy. I'll mention the prearranged sale. I mentioned the prearranged sale earlier. I'll just mention briefly that when a corporation is about to be sold or merge or undergo an initial public offering where a bunch of the stock will be sold into the market, those are situations where the stock that's being gifted, if that's going to be part of the transaction, you need to watch out for the prearranged sale issue where basically the stock is already committed to be sold or used in the transaction before the charity even receives it. And that's the risk there, that the donor is going to end up recognizing gain that they don't expect. Options and warrants.
Matt,
oh, go ahead.
Matt, as you're mentioning the prearranged sale, it sounds like that can apply to closely held stock too. Then we're talking any type of sale, prearranged sale of any type of asset.
Yeah,
right?
That's right. That's right. Even publicly traded stock, if there's a tender offer in the market, we've seen the prearranged sale issue come up for even publicly held stock. It needs to be gifted well ahead of any legal obligation to sell to the offerer. So yeah, any kind of asset this can come up. I'm gonna skip over warrants. Basically, the short answer is that stock options and warrants that are issued in exchange for work, so as compensation, generally do not make good charitable gifts for various reasons. Sometimes they just can't be transferred at all, and other times they can be transferred, but there are negative tax consequences to the donor. So when a donor comes up with an idea where they're going to donate their options, it's often in the charity's best interest to explain to them why that's not going to be a good donation for them to make. And then I'll talk about S corporations briefly. S corporations are never publicly traded. They're always closely held. And because of their tax structure, they're basically a pass-through entity. They raise significant unrelated business taxable income issues, which I think Tracy's going to cover a bit later. Because they're always closely held, and the tax rules around S corporations require them to only be held by a small number of individuals or certain trusts, the universe of potential buyers is smaller, so there's also a liquidity issue there. All right, more business interests. So we see more and more these days gifts of business interests or investment fund interests that are formed as limited liability companies or limited partnerships. I see especially a lot of investment funds, venture capital funds that are set up this way, and somebody wants to donate a limited partnership interest to the charity. Unlike a corporation, a partnership, the liabilities of the partnership are passed up to at least some of the partners, the general partners. Limited partners usually have limited liability, hence the name, but that doesn't mean zero liability. So this is always a task for the charity to review the partnership agreement carefully to see what, if any, liabilities or costs are passed through to the limited partners. And also they need to watch for potential capital calls. With investment funds, they often have capital calls where the general partner or the manager can require the limited partners to put in more funds at some point, maybe with some trigger. If there are any outstanding capital calls, then when the charity receives that limited partnership interest, they're going to become liable for those. They're going to have to pay those, make those investments, and they may not have recognized that was part of the cost of taking that asset. So that's something that's just a diligence matter to make sure that somebody reviews the limited partnership agreement very carefully before taking that asset. If anybody ever offers the general partnership interest to a charity, usually that's not a great idea. The general partnership, the general partner does take the liability of the partnership, so that's often sort of unknown level of risk associated with that, and most charities would be best advised not to get into that at all. As to liquidity, much like S corporations and other closely held business interests, there are often a lot of restrictions on who can own the asset, so who the charity would be able to sell to, and so that's just another issue for the charity to be concerned about. And unrelated business income, again, because these are pass throughs, the charity may end up recognizing income from the business activities of the partnership. So that's something that's sort of an ongoing holding issue, which Tracy talks about a bit later. But it's important for the charity to think about it on the front end, because that's going to be something that reduces the overall value of the asset to them. And I'll talk brief. So sole proprietorships. This is where there's no actual business entity. The business is just basically a collection of assets and liabilities. And if somebody's trying to gift this to a charity, what they're really trying to give is all of the assets and all of the liabilities directly to the charity. This is almost never a good idea, and I always would advise against it. It's much better to have the donor drop the whole thing into an LLC and then gift the LLC interest. All right, real estate. So we talked already about the big thing with real estate is the big concern is always sort of environmental risk. There's also sort of slip and fall type liability issues, and the sort of solution to that type of risk is to set up an LLC or separate LLCs for each gift of real estate. Many charitable organizations are now pretty comfortable with sort of the minimal cost of setting up additional LLCs is far outweighs the risk of taking assets like this directly or having to turn them away. Another issue with real estate is carrying costs. I mentioned you can have property tax, you can have cleanup costs. I had a charity that received what should have been a very valuable piece of property in a residential neighborhood, but it turned out that it was fairly heavily wooded, and local ordinances required cleaning out the underbrush fairly regularly to avoid fire hazard, and that ended up costing more than the rental income of the property, and the asset was harder to sell than they expected. So that ended up being sort of a negative liquidity issue where they not only could they not sell it quickly, but they were actually paying to hold it. I'm going to skip the partial interest issues, I think, just in the interest of time here. But if anyone has a question, of course, you can always follow up with us or ask through the Q&A. And we'll get to questions if we get a chance at the end. All right, other assets. So cryptocurrency, we've been seeing more and more gifts of, including some very, very large and highly publicized gifts of cryptocurrency to charitable organizations. We probably all know by now what cryptocurrency is, and we also all know that it can be very volatile in price, so valuation is an issue. The donor will need an appraisal. Cryptocurrency is not money, it's not cash, and it's not publicly traded stock, so a donor needs an appraisal to substantiate their deduction and show what the crypto was actually worth on the date of the gift. There's also an issue not just for the appraisal, but for the charity itself on how it records the value, how it reports the value of that asset, because it can fluctuate so wildly. There's a risk of having financial reports show a huge paper loss just because of the fluctuation of these currencies. So most charities now have that receive these gifts, that accept these gifts, are basically liquidating them same day or next day. Just as a matter of policy to avoid that risk of undervaluing or overvaluing the asset. Patents are an interesting gift that we see sometimes. The donor has come up with a process or something that it has patented, and it wants the charity to get a financial benefit. But if the patent isn't licensed to anyone, then it's not generating, there's no revenue stream, and that may not actually be all that valuable an asset for the charity. Patents are time limited, 20 years usually, or 14 in some cases. And if it's not generating income now, maybe it never will. And meanwhile, the value of it is decreasing as the time is marching on. So there can be a liquidity issue there. The other interesting thing about patents is that there's special provisions in the tax code for how the deduction is calculated. So a donor may think that they should get a fair value. Their deduction should be based on the fair value of the patent, whatever they think that might be. But actually, the deduction is based on their cost basis in the patent, which is often zero, and then a stream, sort of a 10-year period where they get deductions based on what the actual income generated by the charity from the patent is. So that's sort of a donor education point of making sure they understand and that their advisors understand how that deduction will be calculated, and that they might not receive any deduction at all if the charity can't make any money off the patent. I'll mention emission reduction credits very briefly. These are credits that businesses can get for polluting less than they are permitted to under various state programs. And then with those, what they can do is sell those credits to other businesses that, for whatever reason, need to or want to pollute more. Whatever you might think about whether this is good environmental policy, these credits are assets. They can be bought and sold, and therefore they can be given to charity. We have seen a couple of instances of businesses wanting to gift their credits rather than sell them to some other business to let them pollute more. The problem is so far that each state is a little different, but the way that the marketplace works can be complicated and difficult for a charity to sort of allocate the resources to understand how the market works and how to monetize those credits. So so far, most of the sort of proffered gifts of these to charities, we've seen the charities basically turn them down just because they weren't clear on how they would go about monetizing. I think it's over to you, Tracy.
Yes, it is. Wonderful. Thank you so much, Matt. So we've focused a lot on the gift that's being given and issues that the charity should consider before receiving it. But one of the other issues to think about is what type of charity is receiving the gift, because there are some specialized issues if the receiving charity is a private foundation. And most of these are issues for the donor. But as part of this discussion, we at least wanted to make you aware that if we're talking about receiving a gift by a public charity, we may have a few additional things we need to think about if the recipient is going to be a private foundation. So the first one is a self-dealing issue. So Matt mentioned the potential to have a gift where the donor receives or retains some sort of economic interest. If this gift is given to a private foundation, can result in self-dealing issues, which is a penalty and special reporting that needs to happen. And the penalties are paid by the donor who's the one receiving the benefit. So it's very difficult to give a gift to a private foundation and retain any sort of benefits. So we've got to be thinking about that piece. Another one is excess business holdings. We've talked a lot about receiving gifts of businesses or stock, S corporations, LLCs. Private foundations have certain restrictions on how much they can own, especially if it's an operating entity. Sometimes if it's purely an investment entity, we can get around some of these excess business holding rules. But if you have a donor who owns 50% of a company and they think they're going to give it over to their private foundation and get a great tax deduction, there may be some restrictions there because the private foundation would be required to liquidate within a certain period of time, depending on the circumstances. So the third one we have on screen is the net investment income excise tax. So one of the great reasons to give appreciated property to a charity is the donor doesn't have to recognize taxable income on the appreciation. But in many cases, you can still get a fair market value deduction. So not only do you get a higher amount of a deduction, but you're also avoiding, as the donor, having to pay income taxes on that appreciation while you held it. On the other side of it, if a private foundation receives an appreciated asset and they sell it, they're going to have to pay a 1 or a 2% excise tax on that appreciation because the donor's basis carries over, not fair market value. So we see this all the time where a private foundation will receive gifts of appreciated assets. They need to get the donor's basis, and then when they sell it, they have the 1 or 2% excise tax. Liquidity is especially important for a private foundation because they do have minimum required distributions on an annual basis. You can do a whole bunch of giving in 1 year out to other charities or for your charitable purposes and have that carry over for 5 years, but most private foundations are going to have some sort of spending requirement in order to qualify as a private foundation. So if the private foundation is receiving a large chunk of illiquid assets, they're still going to have a payout requirement on those assets, except if they're using them in their own charitable purposes. So you could end up, say, with this big commercial building, which is a great asset for a private foundation to have until they lose the tenant. Then they have this big, very expensive building without any rental income coming in, yet they still have the requirement to spend out. So it can be extremely challenging putting an illiquid asset into a private foundation. Definitely possible to do if, in addition to the illiquid asset, you have a whole bunch of cash or a donor who's willing to put cash into the foundation to make sure those payments can be made. But it's an important issue for a private foundation. You also get a less favorable donation as a donor giving to a public charity. Pretty much the rule of thumb is you're going to get fair market value if it's cash or publicly traded stock, but otherwise you're almost always looking at basis. So if you're looking at appreciated assets, often you're not going to want to look at a private foundation unless if it's publicly traded stock. You're also going to have a lower AGI threshold. So the idea here is if a donor is extremely philanthropic and they're giving a large percent of their taxable income every year to charities, they could bump up against these thresholds where they aren't allowed to take the deduction in the year that they make it. Now, they can carry it over for 5 years, but if you give to a public charity, you can take a higher percentage of your adjusted gross income each year, so there'd be less carryover. Private foundations are generally going to have a lower percentage, a 20 or 30% for a public charity, instead of a 30, 50, or 60% deduction if they were to give the same exact gift to a public charity. So we're going to have our next polling question, Kendall.
Thanks, Tracy. For our third polling question, what issue or issues have you encountered in holding a complex gift? A, higher than expected operating expenses. B, unrelated business income. C, donor restrictions to comply with. D, negative legal implications. Or E, more than one of the above. For those of you that would like a copy of today's slide deck, you can download them from the folder that says Slide Deck and Handouts to the right of the slide view. We will also be sending the slides via email after the webcast. Back to you, Tracy.
All right, lovely. So it looks like a large number of our participants have had more than one of the above issues, which I'm not surprised. When you're dealing with exempt organizations that are willing to take complex gifts, you're going to run into issues. This is why the gift acceptance policy is so important, to think about all of these pre-acceptance issues and make sure that you're comfortable where you're comfortable and where additional scrutiny is needed before you receive them. So after you receive them, hopefully you were aware of these issues that you're going to run into when you maintain those complex gifts or hold them. Now, if your intent is just to immediately sell it, this section is not going to be as applicable as more the disposing section. But a lot of times, exempt organizations will receive the gift, and they'll either intentionally or unintentionally have to hold it for a while. So some things that they need to consider after they've actually received the gift are the cost to carry the gift. So Matt had talked quite a bit about the expenses that can come along with holding and maintaining operating companies or real estate. You could have homeowner association dues that need to be paid. I have seen exempt organizations receive interests that along with them came capital call requirements in the future. So that can be very challenging if you weren't anticipating putting more money into this investment. Partnerships and S corporations are flow-through organizations. So as that income comes to the charity, if it's unrelated business income, it's going to be taxable. And if it's an S corporation, 100% of that income is going to be taxable. But there aren't always requirements for that S corp or that partnership to make cash distributions for the partners or the shareholders to be able to actually pay those taxes. So before receiving, and then while you have these interests, you need to have an understanding on if you're going to be getting cash to pay those potential additional taxes. So unrelated business income, hopefully you're already familiar with this idea, and we've referred to it a couple times. But the idea is a tax-exempt organization applies to the IRS to receive income tax exemption. That's the basic exemption, although it does sometimes come with property tax exemptions or sales and use tax exemptions. But the main one we talk about is income tax. The code is written such that if you get income that's related to your exempt purpose or is a passive type or specially excluded from being taxable income, then you are treated as either a corporation or a trust, a taxable entity, and have to pay income tax on that income that's not related to your exempt purpose. That's how we get the unrelated business income term. So when we have assets that we know are going to generate unrelated business income before we receive them, then we have obligations to file 990Ts. Sometimes we have state filing requirements, and we've got to prepare for those estimated tax payments and tax return payments that need to be made. The legal liability associated with the asset, hopefully you've done that assessment before you receive the asset. That can change over time. It's entirely possible that you accept some property that didn't appear to have any legal or environmental issues, but after you've held it for a couple of years, you find there was a problem that no one had identified previously. So receiving the gifts it requires you to look at the liabilities you know about, but then you could, by keeping that and not liquidating it pretty quickly, you could be opening yourself up to future legal liability, either that was there before you received it or that developed while you held it. Donor restrictions or expectations is an area of complex gifts that can be very difficult to navigate. Donors who just come to you with an asset and they just want to give it to you and walk away are, of course, preferred. But many times you'll have donors that give a fair amount of money or an asset, and they have expectations on how that asset is going to be used. They sometimes will put in their expectations, you're going to hold it at least 3 years because they don't want that 8282 filed with the IRS showing that it was disposed of within 3 years of receipt. And sometimes there are unwritten expectations the donors don't always tell you about before they give you the gift. So to the extent you can take care of and document and everyone's kind of on the same page with donor restrictions or expectations up front, that it certainly makes it easier, but that doesn't mean that the donor expectations won't change down the line. So keeping in contact with the donors, if there is a continuing expectation, is really important to make sure that that hasn't changed. I've had a couple circumstances where we had a donor who gave to an exempt organization and then passed away, and the beneficiaries came back looking for money to be returned, things like that. And we'll talk about that specific issue towards the end of the presentation, but knowing and keeping those expectations in mind as you're holding the asset is really important. And then if circumstances change, it may then change the charity's decision to hold the asset. If the donor decides that they have the expectation up front, you're going to use it a certain way, and you no longer have that program that that asset was being used in. Let's say you received a gift of a bunch of buses, and the expectation is that you're using it in transportation for charitable purposes. Well, if you decide there's just too much liability and too much cost with providing that transportation program, you then need to address the donor's expectations or requirements, depending on the grant, to use the buses in that way. So what may look to have been a we're going to hold this asset decision may need to be revisited, and it may turn into a we need to dispose of this asset. It can also turn into, boy, we didn't set up a legal entity for that asset at the time, but now it looks an awful lot like we need a single member LLC, or we need to have this in a separate legal structure that's going to provide us some more safety and security.
Yeah, and I'll just jump in if that's okay, Tracy.
Please, go ahead.
We had sometimes the donor restrictions are actually legally imposed if they've really written in a restriction on how the asset can be used. I had a client that was a college and had received many years ago a gift of a building that was adjacent to the college campus, and the donor actually put in the will that the building was to be used in perpetuity as part of the campus of the college. Many years later, the college had sort of outgrown its campus and decided to move across town to where there was more space and sold off all of its old buildings. But it was sort of stuck with this one building that was restricted to campus purposes that was now several miles away from the rest of its campus. So there's a question of, do they need to use that for campus property, even though it doesn't make any sense anymore? Can they sell it? And if they sell it, do they have to sell it to some other college that will use it for campus purposes? In that case, what we actually did was we went to court and had the court agree that just because of the changed circumstances, they could sell the building and then treat the proceeds from that sale as restricted to campus purposes. So as long as they use those proceeds to buy another building at the new campus, that was good enough. But we had to go to court to get that approved. That's not something that you can't just always override the donor's wishes just because circumstances changed.
Yep. And if the donor's still alive and still involved, you might be able to go and have that discussion and have those restrictions changed. But too often you've had the property for a while, or the donor's no longer available, and you do have to go that court route to have things changed. There are some types of donor restrictions that could prohibit the foundation from accepting the gift if the donor's expectations are going to do something that would result in your loss of exempt status. So if they are expecting you're going to use that asset for political activity, that you can't accept the gift. You might also have gifts where it's just untenable. You cannot fulfill what the donor wants you to do with that asset, and then you've got to, it's not that you legally couldn't accept it, it's that it's not business prudent to accept it. So you definitely have to think of those things before accepting. In way of closely held business interest, C Corp stocks, pretty easy, right? There's no flow-through aspect here, so you just have the asset on your balance sheet. Generally, you're going to be marking it up and down the market each year, especially if you have an audited financial statement, and you're going to be accepting dividends, and then when you sell the stock, you've got the cash from those proceeds. Hopefully you have, an ability to sell that stock. If it is closely held, of course, you're not going to have as many options as if it's publicly traded, but it's not impossible. S Corp stock, I can't tell you the number of times I've gotten a K1, and the client is so used to having partnerships, and all they ever invest in is partnerships, but then they randomly received a gift of an S corporation, and they don't realize that they've received that S corporation gift until I get the K1, and in the upper left it says it's an 1120S instead of a 1065, and I have to inform them at that point that all of this income on this K1 is unrelated business income. So there is definitely more complexity. I don't see nearly as many gifts of S corporation stock just because the charities don't necessarily want them because of all the issues that we're talking about. We will have carryover donor basis on S corporation stock, and then you increase and decrease your tax basis by the activity that's flowing through to you and that you're reporting on your 990T each year. So when you're holding S corp stock, there's a little bit more work that's involved with it because you do need to track that basis. When you have an LLC or a partnership interest, as Matt had said, you're stepping in the shoes of the partnership, and so you're getting your portion of those liabilities. So there is an ongoing liability concern, and you'll want an understanding on if you're a general partner or if you are a limited partner and how that's going to affect your risk tolerance level before you accept it. And then as you have it, of course, circumstances can change. So reassessing if it's still a good business to be in. Unrelated business income. So if the limited partnership or the partnership or the LLC, they're all kind of for tax purposes treated the same way. If it's doing activity that would be unrelated business income if the charity did it directly, then it flows through the K1 and is taxed at corporate or at trust rates. So we have to be looking at these K1s that we get every year to make sure that we're capturing that income and talking with the managers of the partnership so that if there is some sort of liquidity event within the partnership or activity that's new to the partnership, that they're letting you know ahead of time when that's coming so you don't get the K1 and then have a big surprise that you have unrelated business income on it. I have had times where there were partnerships that were, because of the nature of the activity in them, not generating unrelated business income on a regular basis. Then there was a change in circumstance for the partnership during the year, the sale of a building, for example, that was debt financed, and this huge gain comes flowing through that no one on the client side had an idea was coming, which can cause a lot of angst and a large tax bill. Hopefully you also have cash from that liquidity event to pay that tax, but it's always preferable to get a heads up to be able to minimize interest and penalties and register if you need to in appropriate states. Foreign filings or reportable transactions also flow through. So if the partnership you're investing in is a U.S. partnership, or you've received as a gift in this case, if that partnership transfers money to a foreign investment, foreign corporation or partnership as part of their activities, that investment carries with it, or that transfer carries with it, a requirement to report to the IRS if you're over certain thresholds. So that is reported on the K1 summary or the K1 footnotes that you receive, but it's an obligation that becomes yours. So if you're accepting a gift of a partnership, you are accepting more complexity than if it's just stock. Matt, would you like to talk about the Attorney General issues?
Yeah, thank you, Tracy. I'll talk about these briefly. Basically, this applies to all gifts, not just complex gifts, but charitable organizations. The board has an obligation to protect the assets of the charity, and that includes investing prudently. The Unified Prudent Management of Institutional Funds Act, or UPMIFA, is the law in 49 states, and even the 50th state has similar laws on the books. This can be tricky if you receive a huge complex gift, for example, a portfolio of real estate that's all in one city, and your donor either expects or actually requires you to hold it indefinitely or not break up the asset. That's a very concentrated position in a very particular market, and that can raise issues for diversification. As a realistic matter, I don't see the attorney generals of states go after charitable organizations for failure to diversify unless there's something else going on, some self-dealing issue or some other concern that the attorney general has that would make them sort of look at everything, and then they might throw in failure to diversify as a separate issue for them to investigate. But it is a requirement, and there is a fiduciary obligation to protect the assets of the charity. I can go on to the next slide, but Kendall, do you think we need to do that last polling question before we hit time?
Sure, we can.
Okay.
So for our fourth and final polling question, have you ever been involved with a request to return a gift? A, yes, due to my involvement with the nonprofit. B, yes, due to a relationship with the donor. C, yes, as an advisor to the transaction. Or D, none of the above. Once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the CPE progress window to the right of the slide view. And Matt, I'll pass it back to you.
Thanks. Okay, so it does look like some participants have seen this issue from the nonprofit side, especially, and many of you haven't. So this is an issue that comes up a fair bit, and let's see, where's this? This is an issue that comes up a fair bit where the donor has made a gift and then for one reason or another wants it back. It may be that they've changed their mind about which charity they want to support. It may be that they didn't get, or they learned after the fact that they weren't going to get the tax benefits they expected. Sometimes it's a matter of them having given the wrong asset, an asset that they didn't mean to give, maybe the wrong block of stock, a block of stock with a higher basis rather than a lower basis, or with a different holding period, and they want to sort of swap it out for the correct asset. This raises a charitable trust issue. The attorney generals, as I mentioned, regulate charities, and one of the issues, other than that diversification issue, there's just sort of this general requirement that, or understanding that all charities hold their assets in charitable trust for the benefit of the public, or for the benefit of their charitable class of recipients. And so giving an asset back to a donor is not part of their charitable purpose, and that's considered a wasting of charitable assets. And in some cases, the board members may actually be obligated to compensate the charity, to basically make the charity whole for having given away this asset that was restricted for charitable purposes. The situations tend to fall into two categories. In the first category, and in my experience the most common, the board actually does want to be able to give the asset back. This is because of donor relations, as we talked about. And so they're looking for guidance on how they can get comfortable doing that. It comes down to a question of whether returning the gift is more valuable to the charity than keeping it. And the board can look at all manner of what they think, in good faith, what they think is the value of returning the gift. So improve donor relations with this particular donor, avoiding bad press or conflict, longer term reputation of the charity, avoiding legal action, So these are all issues that the board can consider in deciding whether they can actually give this asset back. Two things that the donor can do to make it easier for the board to give the asset back is one is to offer to make a gift of equal or greater value at some time in the future, and the other is to threaten to sue the charity. And actually, there are times when we kind of, on the charity side, kind of wish the donor would threaten to sue because that would make it an easier, and then we would have a bona fide legal dispute that we could settle by transferring the asset. It has to be bona fide. We can't just sort of call them up and tell them to threaten to sue us. We have to wait and see if they really are willing to sue. And then less commonly, the board doesn't want to give it back, and then that's just a question of whether the donor or often the other beneficiaries of the will, the children, have standing to sue the charity to get the asset back. And the short answer is that they usually don't. Unless there was some sort of fraud, there's usually no standing to go after the charity to get that asset back. So when the board doesn't want to give the asset back, they can usually just say no if they're comfortable doing that. Back to you, Tracy.
All right. So if you can stay with us for just a couple more minutes, I recognize we're at 11, so totally understand if you have to drop off. But we didn't want to leave without talking for a couple minutes about disposing of complex gifts. So we've mentioned before that you have donor restrictions, often written at the front end of the gift, so you understand what those restrictions are. Might have to go to court, might have to go back to the donor if you decided that you do need to dispose of that gift. Expectations are a little harder because, sometimes they're not down in writing. It's not a legal obligation to keep the gift, but there is an expectation, especially if you have a continuing relationship with the donor. You want to make sure that you're massaging that relationship and communication so they don't learn that you're disposing of it in the paper. That's not generally a good thing if you care about continuing donor relations. You could have unrelated business income if you're disposing of S corporation stock or an LLC or a partnership interest that has debt financed elements to it. So just because the K-1 doesn't say there isn't unrelated business income doesn't mean there isn't, because that gain on sale isn't reported on the flow through. Lingering liability, so just because you sell it doesn't mean you're off the hook for everything. There could be issues after you dispose of it, and you just need to be aware of those and keep them in mind before you actually do sell it, so that if you need to accrue a liability or be prepared for blowback for a couple of years, you can do that. I've had a couple questions in the Q&A asking about the 8282. So if you dispose of a property or an item that you received that an 8283 was supposed to be filed because of its value or the type of asset it was, if you dispose of it within 3 years, not like using it up within your charitable purpose, but you sell it, or auction items, this applies too, you're required to file a Form 8282 within a pretty short window, and you file a copy with the IRS and with the donor, letting them know who it was sold to and how much it was sold for. So I often get the question, boy, if someone donated a piece of land to me and the 8283 said it was worth $1 million and the charity sells it within 2 years for $200,000, does that increase the risk of audit to the donor because you have this huge spread? Well, it can be explained if there's a change in circumstance or a change in facts from the time that the qualified appraisal was done for the $1 million to when the asset was actually sold for $200,000. So if there is a change in circumstance, you have a qualified appraisal, you're just fine. It's when you don't have the qualified appraisal that you're more likely to have a problem. If someone didn't hire the right appraiser or didn't do the due diligence at the front end, if the IRS were to come back and say, this looks fishy to us, it looks like the donor took too big of a deduction, you don't have the support that you need for that initial donation that was taken. But Matt, I don't know about you, but I haven't seen an increased risk of audit on the donor side for 8282s being filed. And I've also not seen a whole lot of enforcement by the IRS if an 8282 is not filed. I think these things fall through the cracks quite a bit because the people receiving the donations don't note in the system that it needs to be tracked and reported if it's sold within 3 years. But so far in my practice, I haven't seen this increased IRS activity. Have you had a different experience?
No, I haven't, and I think you're right that it's that the IRS systems, at least now, or at least in the past, have not actually matched up 8283s with 8282s, and I'm not clear on why that is, but that does seem to be the case.
Okay. So with that, I think that covers most of the disposing issues. We do have some questions in Q&A. So Kendall, I'm going to turn it back over to you to close us out and address how those are going to be dealt with.
Thank you, Tracy and Matt, for a great presentation. Unfortunately, we are out of time today, but if you submitted a question that we did not get to, we will do our best to follow up with you after the webcast, or you may reach out to the presenters directly. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 3 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete the survey as your feedback is very important to us. Thank you for joining us. We hope you'll join us again next time.